More importantly, it's thank you for spending the time to come on this session with me. We've got a lot to get through. Many of these strategies came out of our recent 4-day family Smsf accredited advisor workshop. So to try and condense everything down into virtually 1 hour is an impossibility. But if anyone can do it, it's obviously going to be me. So we're going to have a bit of fun here. More importantly, we're going to look at not only just SMSFs and strategies around that, which are fairly important, but also family SMSFs. For those who know me, for probably the last, certainly I started about 15 years ago around on family SMSFs, but it's really picked up speed because of the change to the transfer balance account. Obviously, the concerns coming up in relation to the abolition of refundable franking credits that are starting to poke their head up. And more importantly, the move to the 6-member rule has really given me a way of going right back to the start and learning about innovating and starting to build family SMSFs, which we're going to look at today as well, and why they're so much more important than typical SMSFs. But we've got a lot to go through, and please feel free to ask me any questions along the way, and that's what we're there for. For those of you who are strategists and also family SMSF advisors, we have our Q&A session on the 19th of July from 12:30 Australian Eastern Standard Time. I've got a couple of nifty little case studies to look at on that session, but more importantly from that perspective, please bring along your best case studies. You can ask me questions and we'll really get down into the nitty gritty. So it's going to be hands-on. I'll be going through the legislation, but we'll also be having a lot of fun. So for me, SMSF advising is about strategy. It was at the start, and I was there right in the start, 1993. In fact, I remember making comments to the actuaries who wrote the superannuation industry standards bill. So if we had a look at that was quite an industry supervision bill. That was quite a radical time at that point. In fact, it was interesting at that time. I do remember that they were saying that if you had individual trustees at that time, the only way a lump sum could be paid was for a pension to be commuted. And that's always been the case that I've argued, and particularly now with the transfer balance accounts, anyone who has individual trustees and potentially is running into a transfer balance account issue, effectively you haven't got a self-managed fund, you haven't even got a superannuation fund. In fact, you've got a fixed trust that doesn't distribute, which means the trust should be paying tax at 47%. Anyway, that's by the by. We covered that in that 4-day course, but that was one of the first issues that was raised way back in 1993. The government never adjusted that. Mind you, since 1993 up until 2018, where we stand at the moment, if you'd focused on your investment route, it's basically a slippery slope. When the market turns, your clients don't want to know about you in any way, shape or form. So that if you've sold your SMSF, much the same as we saw in the Royal Commission based on investments, property investments, whatever, when the market turns, effectively people get egregious or get disaffected with the SMSF itself. However, if I can manage the strategy and over a period of time reduce my family's overall tax rate from say 30% down to 5 or 6%, then the long term that leaves a huge investment. It doesn't matter what we're invested in, it's always going to be better off because we're paying low taxes. Now, for many of you watching this, this is exclusive broadcasts for our scholars, strategists, and also FSAs. But really, for many of you, this one session, you're SMSF strategists. So you're very good at building strategies for high net worth clients, and I think that's a great thing. We all know about the TBA. We all know credits and debits and that sort of stuff. We might know a bit about estate planning and Katz and Grossman, a little bit about reserves. We know the basics, but we're comfortable and we know our laws, but we still want to challenge that status quo. Not all SMSF advisors are strategists, so they're not strategy-based, they're either investment-based, But what I've seen in that 2 years that I took not really a hiatus out of the industry, but effectively sat back and had a good look at what was going on. I saw, particularly with the TBAs, that accountants and mainly administrators were starting to really, push through commentary. A lot of articles were based on accounting stuff, which is okay, but really, I'm a strategist. I'm not an accountant or administrator. If I was going to play down there, then that's the end of my life anyway. So it seems to me as though the industry has got to a stage where the tail is wagging the dog, and effectively we're the head of the dog, and we're the ones who drive the whole business. And if you don't do that, you will not be adding any value to your clients. And you can see that a lot of clients don't respect or don't understand value, because for too long they've had their accountant or administrator charging them a set fee for essentially just providing administration, and there has been no advice. Now, of course, that's also an issue with the AFSL side around accountants, and that needs to be sorted out. The move up to a higher level in terms of the Smsf industry, and certainly CPD. For example, this CPD is set at what we call an AQF level, so that's the Australian Qualifying Framework under the training standards of around about a 7 or 8 compared to typical industry, which is around about a 6. That is essentially going to go up, and I can do a whole session on training standards, where we're going and that, but that's not for this. For me, if you're really going to go up, and the higher we can go up on that AQF framework, it builds a barrier to entry for competitors. And we've seen really in SMSFs that every man and their dog has come in and started to attack that industry. Prices are going down in terms of audit. Prices are going down in terms of administration costs. The more and more integrated we get with, for example, different bank feeds, etc., administration costs are being reduced all the time. Likewise, at one stage, you're going to see the SMSFs will be able to be effectively compliance driven through the Australian Taxation Office, which is certainly where the 3-year rule is going very shortly. So from that perspective, administration is going to be really a very low cost factory style effort, and a lot of people who are doing administration will effectively go out of business or start to merge, and that merging game is already starting to play. Now, if you're at the high end and you're a strategist, so put your hand up if you're a strategist, even if it's in your mind right now. Family SMSFs are a whole new ball game for me. 6 members, and this is the key here, multi-generations, family trusts working in joint ventures or partnership or alongside family SMSFs, family SMSF proceeds trusts, which are on the estate planning the norm. So I haven't got it here, but if I could draw a picture for you, you'd have your family trust, your family SMSF proceeds trust embedded into your estate planning, and you'd start to bring all of that together in a very seamless, one cohesive atmosphere or ecosystem that would minimise tax to the best extent possible across the family group. So we're not looking like mum and dad to reduce their tax, we're looking at a whole family group. And once we get to there, then we take ourselves to that next level of not only superannuation or SMSFs or accounting or planning, we're actually taking ourselves to be a real, it's even more, it's a lot better. I was going to say more better, but that's not really very good English. Our sales guy, Phil, would hit me over the head for that one. But it's a lot better than, for example, our family houses. So once we start to build this, we're really limiting the number of clients we have, but increasing the underlying value for there, and also increasing the underlying costs for them. So for me, family SMSF advisors are the elite of the elite. And the question that I put it to you is, do you want to be part of that elite? A lot of the strategies are going to go through, and you'll certainly see down the track, are very important for both SMSFs, but they really take that next level when we get to family SMSFs, as you'll see later on in the session. So for those of you who are on our membership program, you would have got this the other day. So this is a reprise of the strategist. The first one I ever did was in June 1996, and it went for 100 volumes. This is now the first of the reprised The Strategist. And look, I'd encourage you to make sure that you read all of this, print it out and send it around the office, because it really gives you a platform, a format, a view of where we're going in the next 5 to 10 years. If you can understand this, it goes into the history of where we've been, and it goes why family SMSFs are important and a lot of the strategies we've got. So although I'm going to be talking about some of the high points, really you've got the strategist, that first one, the top 5 SMSF and family SMSF strategies available there for your use. If you haven't got that, please contact Phil. So that's Phil at ilovesmsf.com, and he will shoot you through a copy. Now, forgetting about everything, so forgetting about tax, because we all like tax, but if I asked your clients, and in fact I asked you, what's one of the most important things in your life right now, most of you aren't going to say tax. Most of you aren't going to say SMSF, nor would your clients. But the big things that come up for a majority of our clients, particularly the high net worth, is a family is really important to them. The second one is security of income for the rest of their life. And usually the third one is health. Travel usually comes in as a subset of security of income. And that's why the SMSF can be looked at in isolation for a couple. So when we have a look at it, we say, okay, well, it's not too bad. We can use that. We can set up a security of income, a bit of estate planning around that, but we don't look after the family. The only way we can look after the family is through estate planning, and that's where it starts to get messy, because an SMSF is an SMSF trust deed, and once we start pushing stuff out, whether it's a binding nomination or more advanced SMSF will or set of directions, once we start to push that out from there, effectively we get caught up in a bit of a worrisome situation, because we're adding additional documents into the process. You can see with Katz and Grossman and Donovan, that's where everything starts to fall down. So why family? Well, family is really important to, I'm presuming, most of you, and also to your clients. If you asked, and you can do a little bit of a sample here, so the next 10 SMSFs or clients or trustees that you have, ask them this simple question: is keeping your benefits, your superannuation benefits, when you pass away in your bloodline important to you? Would you like your benefits to go outside your bloodline? And I can guarantee 99 times out of 100, your clients are going to say bloodline is important, family is also important to them. Hence, the necessity of a family SMSF. Now, if we started to have a look at this, is Australia's generation profile, and I'll make sure that you get copies of all of these slides anyway. But if we go back and have a look at where SMSF's been, you can see there on the far left the builders, which are my parents' generation. There are quite a few SMSFs still around of those, but not too many, mainly because really there wasn't a huge superannuation. People didn't have a lot of superannuation then. They have managed since 2007, when you could do that $1 million contribution. Since that time, a lot of these builders have put in a lot of money into self-management because of its tax effect. In fact, a lot of them are not paying any tax because of the mechanisms of making contributions and limited recourse borrowing arrangements by way of related party loans. Effectively being able to put in large balances into here, and with refundable franking credits, they're not paying any tax compared to their friends and family who are sitting outside of a self-managed superannuation fund, who are paying quite a significant amount of tax. If you think of someone who's got maybe 5 or 6 property investment portfolios, who's 70 years of age and receiving quite a bit of income from there, their tax bill gets to be quite horrendous. The real one for us, though, is if you've been in SMSFs for a long time like myself, the boomers have really driven SMSFs, and there's around about 300 to 320,000 SMSFs in current state of play, which essentially are from the baby boom generation, those people born between 1946 and also 1964. The key thing about those is most of them are 1 or 2 member funds, so typical mum and dad funds. They haven't brought their children in. They really, well, here's what it is you don't know what you don't know. So if your advisor or your accountant has never told you to bring your kids in, then obviously you're never going to get down that stage. And you've probably seen, since I've been talking about family SMSFs, you get a few of the commentators saying, well, you shouldn't bring in. In fact, I saw one commentator said, well, you shouldn't bring in a baby boomer with their Gen Y children. You can see on there, because they're going to have different investment strategies. And again, that just comes from a training level of ignorance. Not ignorance, it's what we call unconscious incompetence. Because obviously, if we're going to set up a family SMSF with different generations in there, then we have different investment strategies. It seems to me to make a lot of sense, and certainly that's why the large retail industry funds offer different investment strategies for different generations. So the boomers are sitting there. The next one is the Gen Xers, and there's about 110,000 SMSFs there, again, just mum and dad funds. And what I'm seeing is we're getting this Generation Y coming through, and even Generation Z, who are a lot more entrepreneurial, a lot more startup minded, etc., who are really getting ripped off by the retail and industry superannuation funds, as many of you have seen, where it's a lot easier for them to, really move from here and here, and just move into their boomers or their Gen X parents' family SMSF. And provided we put some caveats and we put some structures around that, and let's face it, we're strategists, that's our job, we can start to pool these and they then become a legacy. I mean, to have, for example, mum and dad sitting in here, and then a couple of their kids who might be Gen Y, and then one or two of their kids in there, so we've got 3 generations in a family SMSF, is a pretty powerful force when it comes around to tax, superannuation, and also estate planning. And we can really start to play around, because instead of a TBA just being for one member or possibly 2 members in a self-managed super fund, we can now spread it to 6 members across our family. So again, because of the very nature of our population inside Australia, we want to make sure that we're getting that Gen X and Gen Y flowing through. But a lot of them, it's prohibitive because of the amount of funds they have. They can't really set up their own self-managed super fund. So we want to build them into a family SMSF with their parents. And likewise, it's also the reverse. It's good to have your parents inside an SMSF. So if you're, for example, and I'm going to look at the strategy very shortly, but if you're a 40, 45-year-old member inside a self-managed super fund, you're not going to be able to touch your superannuation virtually to age 67 or 68, which is going to be the preservation ages by that time. Whereas if you've got parents already 60, 65, who can access that money, that's a really good little interplay. By just being in that fund with them, you can have a lot of fun. Again, there's a lot of strategies and ideas where we can start to look at different investment strategies or separate investment strategies, employment of parents inside our businesses, so on and so forth. And I'll look for a little case study on there. I'm not sure if we're going to have a huge amount of time to do this. I'll just briefly go through it today. If not, then I'm going to look at it on our Thursday session, our Q&A, and I'll pull it apart for you. So we got 3 types of funds. The DIY, which, gosh, if anyone wants to do their own SMSF, then it's a complete waste of time anyway. But, there are a lot of people out there doing it. But strategy level 1 to 10, you're probably down around about 2. The common or average SMSF, which most people have, I mean, there's only 7%, or there's only about 35,000 family SMSFs in Australia. So that, for me, given the slide I showed you before, the changes in the rules, the TBAs and all that, really means it's a huge level of opportunity. First and foremost is upgrading all of those common SMSFs or those average SMSFs to family SMSFs. So you're already sitting on a gold mine in your existing database. It's a matter of how we attack it, or how we build our business and marketing plans to achieve that. To find out the difference between the 3, you've all got copies, because you're on our program, of the Guru's Guide to Self-Managed Superannuation Funds. I'm almost run out of the latest edition. The next edition, which will be printed up around about 1st of October, when we launch our for our members only, our new documentation platform, which is unlike anything ever seen in Australia, or in fact in the world. It's going to be quite a radical change to the industry, and I'll talk about it a little bit later on. but you would have received a book there. Have a look at page 26. There's probably about 5 or 6 pages on the difference between the DIY, the common, and the family SMSF. For those who are family SMSF advisors on our program, I've done a few videos there for you, and also some emails. So contact Phil at ilovesmsf.com to get those emails and send them out to your clients. Get them pre-warmed up in terms of this idea of upgrading from a common SMSF. And here's the deal. Anyone who's got more than $1 million inside an SMSF, when they're given the opportunity of being in a family SMSF or a common SMSF, around about 95% of them, and I've done this we've done research to more than 500 trustees, do not want to be in a common SMSF. They want to be in a family SMSF. The only thing that's holding them back is, guess what? It's the advisors. A lot of them come up to me when I do the talks and they'll say, well, my accountant advisors just got me in a common SMSF. Why wouldn't they have put me into a family SMSF? Why haven't they got my kids in there when I can see all these benefits? And the main thing is they don't know what they don't know. It's unconsciously incompetent. You can see that from a lot of the queries that are coming around, or a lot of the naysayers in that space to simply say that, hold on, a family SMSF is just simply an SMSF with more members. Well, if you think that, that's like saying, well, hold on, an Aston Martin is a beautiful car, but it has the same impact as a bus or a horse and buggy going from point A to point B. If you don't get it, you just don't get it. But anyway, that's the issue. The common or average SMSF, as we saw in the Royal Commission and really has besmirched the industry, is again another reason why we want to go to family SMSFs, to get away from the typical SMSF people who are promoting, particularly around the property side. Common SMSF is focused on investments and money, mainly driven by the trustees themselves, and we've got the accountant or the administrator doing administration and really basic sort of strategies. I mean, they all put their arms up, and the big deal of the day is the transfer balance account. I haven't heard one person say how to get around the transfer balance account. Everyone just says, well, this is the way it is. You've got to administer, you've got to get this in and that. Seriously, how boring is that? Again, it's the tail wagging the dog. If you don't understand strategy, then you well and truly are left behind. So is family important to you? Absolutely. I'd say that 99.8% of your clients' family is really important to them. Bloodline is absolutely important to them as well. So the beauty about the family SMSF is it focuses on one of the most important things in their life, which is their family, built beyond one generation. As I said, I have built some for 3 generations, and that makes a lot of sense, particularly if we're doing an account-based pension. If we can find a grandchild who is a financial dependent, and it's quite amazing. I'm here in Adelaide at the moment, but 70% of all private school fees, so let me just say that again, there was a study that came out, 70% of all private school fees in fact paid by grandparents as opposed to parents in Adelaide. And that, for me, if it's done right, we do the documentation right, we build it all into our SMSF trust deed, then there's a 9 out of 10 chance that those grandchildren will be dependents or financially dependent. And you say, well, Grant, what's the big deal about that? Well, you have a look at CIS Regulation 6.212, and basically that says that if you're a child, you can't get paid a pension. But a grandchild is not a child. So we can get paid a pension, but up to age 25 or 18, the limited child pensions. But if a grandchild gets a pension, then effectively that can last for the rest of their life. So we can start to skip a generation. So again, this is where family SMSFs all start to come in. The other one is that we can also use that vehicle, if it's got considerable amounts of money in there, to look after the family if they're sick, disabled, retired, wants to work post age 60, supplement wages and profits with super income and spouses, children, grandchildren, blah, 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 blah. So it works really well. For example, one of the things there is all members, and you can actually pull someone in as a member for a short period of time and push them out. So, for example, if something happened to one of my daughters, I can pull her in, use the earnings of the fund to pay out salary continuance payments, and then if I wanted to, I could then eject her out of the fund. Not that I would. I'd pull her in, use the earnings for that to effectively pay out a salary and continuance. At her age, at age 20, the majority of those payments going out are tax deductible. So the fund gets a tax deductible payment, or tax deduction for salary and continuance paying out of the fund. Again, this is not contemplated in a boring, common, average SMSF. It's a family SMSF is fluid and moves around and changes. And you'll see when I talk about how I'm building the new family SMSF deed, why this is really important. But again, also, it's not just, as I said, you're not looking at just the family SMSF. I mean, for a long time, Myers and Baillieu in Melbourne, and there's a lot talk about these family offices. Where you're getting to this family SMSF, you also need to have expertise in relation to family trusts and be able to build family SMSFs alongside family trusts, such you might have a property development or some investment that you go JV with your family trust. The family trust takes on the borrowings, whereas the SMSF doesn't. So again, these are great little opportunities sitting inside there. So for family business, I'll look through the case study. I don't think I'm going to have time on it because I'm really stretched. I've got to get through a lot of stuff. But I want to make sure that we will look at this. Phil will tap me. He's already tapping me on the shoulder saying, look, Grant, you've got to do this case study. It's really important. So I'm going to be doing this on Thursday in our Q&A session. So I'll go through it, though, and I'll give you a bit of heads up on stuff that I'll be looking at. But it's certainly very exciting because it's going to pull everything together. But family businesses, absolutely crucial to put that together. If you've got a family business with a family trust, why wouldn't you have a family SMSF sitting alongside rather than a straight barrel SMSF? Common SMSF just doesn't make sense. Again, though, you'll see. If you don't know what you don't know, if you're unconsciously incompetent, then it's like blah. What we need to be doing is, from all our clients, are saying, well, hold on, you've got an SMSF. This is the package to upgrade to a family SMSF. You guys choose, but obviously we're going to have a premium package for that because we're going to look after all the family. And really, at the end of the day, if you've just got a common SMSF, when mum and dad die or one becomes incapacitated, that's the end of that fund. Family SMSFs, you tell me, when are they going to finish up and die? Well, effectively never, because if you've got the grandkids in, it just keeps on this process. As I said, new membership laws are coming into entrench family SMSFs. Bloodline is absolutely crucial to your clients. You mightn't think it. Ask the question and find out. SMSF will is crucial for bloodline. Binding death benefit nominations are really, in fact, I'd say 9 out of 10 in Australia don't work. And they're basically SMSFs for dummies, and it's extremely dangerous inside of SMSF. So I would never ever do a binding death benefit nomination. I do an SMSF will. As I said before, the family SMSF looks at health and welfare. A living SMSF will is a must. I've done this recently with a group of trustees where we set down some directions that guide the trustee in the event of mental incapacity. So who gets what, what's the sort of benefits that get paid out or continue to be paid out. Because if you don't have an SMSF will in place, a living SMSF will, the remaining trustees, because obviously you don't have mental capacity, can effectively terminate any pension, leave it in a lump sum for you, and effectively just dole out, virtually next to nothing and keeping all the capital for themselves, the next generation. So living SMSF will is a must. Okay, so what can a SMSF, family SMSF really do? What I'm going to do is I'll just go in quickly. I'll give you a bit of a heads up here. So I'm just going to escape out of here and show you the strategist we've got there. While I'm here, I might just, for those of you who haven't been around, our website's only just been up recently. I'm just going to give you a quick fly around so you can have a look what we've got. You've got your home page, which for most of you, you will be getting your logins. If you haven't got them now, make sure you contact Phil, Phil at ilovesmsf.com, or contact our office and he can set you up in all your logins. But effectively, you've got the 3 membership programs. Most of you guys got our special foundation deal. Some scholars, mainly the strategists. The benefits of this, the strategist to me, 10 free hard copies, but those 30 CPD points for not only yourself, but also for 2 other staff members. So when you have a look at that, many of you got it at a low price, a foundation price of $295 a month. That's pretty cheap CPD, effectively 90 CPD specialist, and not at the AQF level like most industry, but up around the level of AQF 8 and AQF 9. The FSAs, have a chat with Phil. If you're not there, look, I said to Phil, look, if this was me and I was being presented the opportunity of being an FSA, knowing that Grant's going to be working and mentoring my business, blah, 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 I'd be putting my hand up straight away and jumping in on that, because, I'm an innovator and like all that. But anyway, it's up to you guys, but you're in one level or the other. SMSF TV, you'll find there's a whole lot of different videos there. You've got our general videos, so that's just basically for everyone. But then we've got our scholars and our strategists and also our FSA videos. I'm sitting down with my brother tomorrow and we're doing some really hardcore strategists and also the next level up FSA videos. So they'll be available there for you, depending on your membership level. Events, this is the page. You're going to see every Sunday events will come through. So for most of you, if you haven't yet registered, you can see here, webinar Ask Grant a Technical Question Forum. So all of these times are obviously Australian Eastern Standard Time. I'll be going through this case study we're about to show you shortly, but the next one is 15th of August, LRBA strategies. And virtually, if you have a look at our content, we've got content really coming out of our ears. There's so many contact hours. Every month there's going to be Q&A, etc. One thing that I do want to point you to here is every second month, the first one's going to be in Sydney. For those of you like in Sydney, even if you're interstate, see if you can get along to this. If you are a strategist member or a family SMSF advisor, it goes from 7:30. This is wrong. It goes from 7:30 until 11 a.m. So it's a bit wrong. 7:30 to 11 a.m. It's a 3-hour session. Allows me to go to deep dive, something a lot more specific than we'll get into this webinar. So that's 7:30 to 11 a.m. For those of you who can't make it, it's video streamed anyway, but that's where you're going to pick up a lot of your CPD. It's a lot more case study oriented. Shop, if you want to buy extra book, you've got my blog, which comes out all the time. And importantly, you also got the strategy forums, which are pretty crucial. So with the strategy forums, just let me log in here and I'll see, hopefully it's working. I know they're still working on the site a little bit there. So, whoops. Oh gosh, don't know what happened there. Oh, sorry guys, I missed out. Look, I'll come back, but the strategy forum's great. You go and put all your questions, I'll go and attend to it. So anyway, here's the case study. As I said, I'm not going to have time to look at it, but I want to just go through it because I am going to focus in on it in our next session. So this just shows you, like, this is just amazing. So the first one is family SMSFs are not SMSFs with more than 2 members. For those that think they are, you're in for a big shock. They are magnificent strategic structures that stand the test of time, family circumstances. Well, if you don't understand my passion around them, look, I could go on and on. Let me give you a simple case study. Now, I'm assuming it's post 1 July 2019 when 6 members are in a fund allowed. I don't really know why they don't do it straight away. It doesn't make sense. By the way, why are they doing that? And also, why are they making the auditors only have to audit every 3 years under a self-assessment business system? I've had a look at the new standards from the Treasury, but effectively, if you have done your compliance well for the last 3 years, you've signed off as trustee that you met the relevant compliance, lodged on time, there's been no qualifications, then effectively you can go and do a 3-year audit. Why are they doing that? And essentially, they've opened up the 6-member to 6 members, which is the family SMSF. They've put the 3-year audit rule in there, and the purpose of that is to essentially take money away from the industry and retail funds, which I think is a great way. So why wouldn't we be working with that anyway? So family SMSF leading member John, now I'll just put that in here. In a true family SMSF where we have bloodline, we have to have a leading member or principal person. So in this instance, it's John, who's age 70, and his spouse, Sally, age 66, are in the Smith family SMSF. They are working graziers, but have transferred their farming business to their son, Matthew, age 40, who is also a member of the fund. The property sits in the family SMSF for the benefit of John and Sally, who are both retired, have pensions with reversions to each other, then to Matthew upon their death to ensure the property is transferred to the son working the farm. Now, I'm telling you right up, a lot of the stuff I've already got here, we're going to go through it on Thursday in our Q&A, but a lot of this is assuming that as a family SMSF advisor, you're already consciously competent. You're up around about a 6 or a 7. I'm going to go through a lot of the issues, and we're going to tweak it and make it even better. But really, if I had to look at this, and if you gave me your client, a client look like this, I'd say, well, gosh, you're really a good 60 to 70% away of being one of Australia's top family SMSF advisors. Let's face it, there's not that many around. Matthew has 2 children, Ben age 17 and William age 13, at boarding school, runs the business through the family trust, and still employs John and Sally. That is so important. Absolutely so important. Employs John and Sally, paying them $70,000 each per annum by way of a super contribution. John and Sally have more than $500,000 apart from the property and dividend-paying stocks in the fund, and these are used to cover their contributions tax and also the contributions tax of Matthew. Again, as I said, if you came to me with this, I'd say, hold on, you're a 6 out of 10. You're really on the right track. The issue I'd be asking is, well, how much are you actually charging these clients? Plus deductible family trust contributions made for Ben and William, who do vacation work on the farm. John and Sally's daughter, Marie, is also a member of the fund, but has her own investment strategy. John and Sally use part of their pension benefits to pay a school allowance directly to Ben and William to cover boarding and school fees. In their SMSF wills, apart from the property to go to Matthew, a lump sum is payable to Marie, with the grandchildren also paid a benefit as an income stream or lump sum. At this point in time, John and Sally have been advised that their grandchildren are their financial dependents, while Marie and also Matthew are not. Now, this is a really good family SMSF working. We'll pull it apart on Thursday. But again, go through the strategist and have a really good look, because this stuff would put you miles in front, in fact, years in front of the typical common or average SMSF advisor. And certainly for those of you starting down this family SMSF route, this is the stuff that really makes it great for us. So let's just jump back to the slides. So, what can it really do? As I said, if we have a look at the strategist case study, we've got 3 generations in there. And we want to, because as soon as the children are working for the family trust, even if it's voluntarily, the family trust can make a deductible contribution to them. In addition, can you believe it or not, the children themselves can also get a tax deduction for a contribution going in on their behalf, mainly because they're receiving salary and wage income or salary and wage contributions, which means that a distribution can be paid down to them, and then they can flick it back in as a deductible contribution. So, and the reverse happens is it's great to have John and Sally as the parents there, because you can see there Matthew is paying them $70,000 per annum. And I'm going to give you a bit of a heads up there. That $70,000 per annum is tax deductible to the family trust, goes inside the fund. But remember, the imputation credits are going to reduce the underlying contributions tax on those. They sit in there. But more importantly, it's going into the accumulation side of the retirement accumulation account, depending on their TBA for John and Sally. And then these can be used as monies in order to pay an allowance to the 2 grandchildren in order to make sure their financial dependence. We're going to be looking at all of this stuff again on Thursday, and looking at the laws. But what we've done is we read, understand, we know the laws, but now we have to apply it across multi-generations. And that's where the permutations really come into play. And that's where, once I start to see, 1,000 different options or possibilities, that's where picking the right one for the client is absolutely crucial. In fact, generally what I'll do, and I've just gone through this process now, it takes a while to build it. In fact, probably at least maybe 4 to 6 weeks to get it right from the outset. And more importantly from that one is by getting it right from the outset, enables us to really set a foundation and build from there, as I'm going to show you very shortly. So getting that right from the outset lets us build it from there. Stage it properly. Who is going to be a member? Who's not going to be the member? Who's the leading member of the fund? What happens if there's divorce? How they get ejected, so on and so forth. Separate investment strategies. So again, looking at the key strategies, how it goes down the bloodline. I'll look at that on Thursday. So what I'm going through is now this is my Elon Musk moment inside of the SMSF industry, or the family SMSF. So I've been sitting around for the last 20 years and had a look at all the weaknesses and all the cases whereby documents, etc., really haven't fleshed out properly as everyone expected. And there's obviously been challenges to documentation. That happens also by the commissioner challenging, virtually under the TBA or pensions not being paid, or minimum pensions, so on and so forth. Let alone, as I said, most binding death benefit nominations aren't even worth the paper, if there were, if there is paper that they're actually sitting on. So what I'm building is now a family SMSF. This will be available from the 1st of October, where we have a mothership, and that mothership does all the administration of the fund. When I mean administration, where the trustees are, where how you can be a trustee when they're appointed, replacement trustees, gives the power of who can be a member, where there's automatic appointments of members. For example, someone's disabled, or a child who's incapacitated, they can be appointed as members, so on and so forth. Talks about all the powers of the trustee, including investment powers, what the trustee can do, separate investment strategies, blah, blah, blah. There's a whole lot there. But then underneath that mothership, if we have a look, it's almost like Star Wars, that we've then got these little member pods. So each of the members will have their own pod. And in that pod, they'll have their own superannuation balances. The first thing is they'll have their own superannuation investment strategy. Now, this may be split across other members inside that fund, but effectively it gives them an opportunity to say, okay, we're in this sub-fund, but we're investing in this pooled investment up in our mothership. But we can also have separate investment strategies for separate accounts. So I could have a tax-free account-based pension, which have its own separate investment strategy, a taxable account-based pension with its own separate investment strategy, and then a retirement superannuation account with its own separate investment strategy. So each of those will be built into the member's pod. From that, there'd be an SMSF living will, EPOAs, living SMSF wills, and there's about half a dozen other things there. The importance about that is that what will happen is this all becomes one consolidated trust deed. Everything is encapsulated under the deed. That will then be sitting in, which I think is quite exciting, a vault. And then from that vault is that each and every time there's a change to our deed, each and every time there might be a change in family circumstances, so you want to change investment strategy, whatever, it updates and automatically upgrades the whole of the deed itself. So it is the securest, most protected, asset protected form of SMSFs that is possible, and really makes a typical common or average SMSF look like a kindergarten versus someone who's just come out with a PhD on SMSFs. So I'm not going to go much further. Where do you want to play? SMSFs, common, average. Do you know what I mean? People can. There's really, apart from the administration, as it goes down, is people can go on. Look, people can go online now and get free administration if they want. Prices are going down. There's not much strategy. Really, where we want to play is up in the family SMSF level. But again, that's not the subject of this talk. We talked about family SMSF advising competency. The very people who are saying that there's a whole lot of problems with family SMSFs is I put them down to the unconsciously incompetent when it comes around to family SMSFs. They're consciously competent in terms of SMSFs and raising issues, but obviously where there's an issue, there's a solution. In fact, I've seen a number of people saying, well, hold on, if you do this, there's an issue, but you could do this if it was a family SMSF. Well, seriously, that's pretty easy. I mean, if we go back to our pods and you're a child member of that fund, then your votes would go to blah, or you only get votes based on your account balances. You choose the process that you want. Again, that foundational setup of the family SMSF is all crucial. Anyway, I've got to start picking up the speed. Strategy 2, again, all of this is sitting inside your strategist newsletter. Make sure you watch out for that. It'll hit your desk the first week of every month. We then have this webinar which goes through a lot of the strategies in it. Then there's a Q&A session for you. There's a whole lot of marketing webinars. So there's lots of stuff coming down the track. Just keep on. Remember, we had a look at that events. Just keep out and subscribe to the events you want. If you're a family SMSF advisor, you can register 4 members. If you're not, if you're a strategist, you can register 3 members. Including yourself. If you're a scholar, you can register 1 member. So you just put in there and you just put in when you do the registration, you put through that, use the coupon code free and you get it in there. Otherwise, it's $95 a webinar, which basically you guys don't have to pay. 2 rules for deductible contributions. All employer contributions are deductible, as are all individual contributions now. Although the member can give the notification to their trustee under section 290(160), basically as to the amount that they are going to claim as a deduction and what's going to be a non-concessional contribution. But really, we can clean out anything that we want by way of deductions. Remember, the deductions we take will clean out the assessable income outside of the fund. Now, I don't necessarily worry about caps because there's obviously tax consequences and financial consequences of that, which I'll work out later. Deductible contributions are assessable income of the trustee. That's fairly important. This is our big selling point of why our children and our grandchildren are being ripped off in industry and retail funds, because there is no set off for franking credits, etc. And really, when they put the money in, at some point in time, 15% is taken out of their balance. Whereas if we get our kids, if we have a look at the case study I looked at before, John and Sally got Matthew putting in contributions from the family trust. Those contributions are working from day one. In fact, we know very well that they're never going to be subject to contributions tax. So if we're looking at the ability, and this is really crucial, that if we've got the ability to make contributions, the best time to do it is obviously in July, not that lead up. Contributions don't have to be in cash. We can, in fact, do in specie contributions. So anything that fits under Section 66, where the trustee of the fund can effectively acquire an asset, we can transfer that in. We can do it under a related party loan and some contribution. We don't know the amount we're going to claim as deduction until year end, but it's better to get it in now rather than, for example, if they're a portfolio of shares, we want to get that in now. So effectively, we get the franking credits from those shares now while the contribution's in there rather than later. It doesn't make sense to have those franking credits outside rather than get them inside the fund. The same with property. We can get them in there, deductions, so on and so forth. We can also do a very favourite one for 30 June, if you saw my webinar, was the use of promissory notes, which are equivalent to cash. So the main thing is we do know that the contributions are assessable income of the trustee, so we've got to work really hard. Getting property, negative gearing and capital allowances. Again, if we've got a property, we want to switch it over. So we've got business real property, we're going to move it in under a mix of contributions and also related party loans. I did one recently where it was a partly developed property, moving that into the self-managed superannuation fund by way of a related party loan. Has to be done squeaky clean, but the beauty about it is the new gnarly bill is very nasty, but also means we don't necessarily need to abide by the commissioner's guidelines in terms of safe harbour. Safe harbour is just one guideline. Now we have to go out to what is true market value. So negative gearing, capital allowances are crucial to reduce the assessable income. Family franking credits. Again, if we have a look at John and Sally, it's just given because you guys are really smart. Remember, you're up around about a 6 out of 10 being family SMSF advisors, that John and Sally's franking credits just shift automatically over to cover effectively the contributions tax or the tax liability on the accumulation side, which is Matthew's side, which includes that assessable contributions being made in. So again, family franking credits, whether we make a payment, the reverse side, so we can make a payment from the retirement accumulation account into the account-based pensions of John and Sally, which is is a great way of doing it because that's uplifting their value, but it is not a TBA. So it's not a transfer balance account credit. So it actually just switches through. Again, the necessity of having separate investment strategies. Temporary capacity reductions, I talked about that a little bit earlier. Early stage innovation companies. I haven't got time to go into that. We'll go through that in another webinar. But essentially, the main thing about that is if whatever capital, so this is not like the negative gearing or whatever capital we invest in one of these asset companies, effectively we're in a position of getting a 20% tax offset for the capital contribution in there. And more importantly, when we sell those investments or those asset companies, 10 years, anywhere up to 10 years down the track, it's capital gains tax free. So absolutely perfect if we think about it. If we've got a good family trust or we're a high salary wage earner, to just drift make a salary sacrifice into the fund, we get a deduction. We've then got a deduction is then assessable income of the fund, taxed at 15% if we don't do anything against it. But then if we invest all of that money, say $50,000 into a probably 4 or 5 ASICs, then effectively we're going to get more credits, remember 20% tax offset, than the contributions tax payable. So it's a bit of a no-brainer. It's where the government is actually helping us invest in these early stage companies. Another one, advanced harbouring capital losses in accumulation. I might leave that one for our Q&A session for our more advanced FSA advisors and strategists coming up a little bit later on because I'm running out of time. Okay, set in place GFC2 measures. Phil is a big one on this and keeps on hitting me on the head, as I am as well. There will be a correction. At some point in time, there's going to be a correction. Interestingly, from this one is the next time there is a correction, the world is a lot more leveraged than it was in 2007. If you have a look at the amount of student loans, both here and also in the US, if you have a look at the underlying government debt in China, well, it doesn't matter where you are, even in Australia, have a look at where we were in 2007 compared to where we are now. So that means that when we do fall, it's going to be a lot harder to fall. But anyway, it's up to you. The main thing that I find there is when we have a look at GFC1, we know that equity and property portfolios drop between 40 and 70%. Some equities are light out. For example, we had a look at ABC Learning Centres and Lehman Brothers were both shorted out of existence. So put in place GFC2 pension measures. So if I have a look at it, I've got, I'll just go back to our strategist newsletter. I've got that on here, a nice little case study, which again, I like to have a look at the numbers. So if I have a look here to show you how it works is simple example, and I like simple. James Earl, I picked that up. I think I was watching a movie about James Earl Jones. Remember, he's got the one with the very deep voice. But anyway, James Earl has a 1.8 million accounts-based pension, which was originally tested 1.6. So it's grown in time thanks to the market. He also has a $400,000 retirement accumulation account from the surplus pension. So he's rolled back. He's now got a retirement accumulation account and account-based pension. Everything fine and dandy. So effectively, he's got $2.2 million in his fund. The GFC hits, and it's mainly share-based investment strategy in the ABP, results in a reduction of the ABP to 1.2. So effectively, he's lost $600,000 there, which is around about 40%. In contrast, he had a separate investment strategy. Here's another benefit of that, of $400,000 in his retirement accumulation account, so that remains the same. So for him, that's still the case. He's still got his retirement accumulation account, but his account-based pension has dropped down to 1.2. So this is, again, the administrators, what would they do with accountants? They just walk along. So that's okay, that's fine. Now, here's the deal. This is where we start to use our strategist smarts. So this is what I want you to put in place. And you're going to be able to do this when we go through the family SMSF trustee, because you'll be able to build this into the investment strategies. So what it requires is, in addition to the ABP pension rules for James Earl, so when we set up the pension, we have a separate rule that says that in the event of the ABP account balance being reduced by more than 5%, obviously excluding pension payments and fees, so we're looking at capital, the pension is to be automatically commuted, subject to the trustee's discretion, and rolled back to the member's retirement accumulation account. This means, so when we do the numbers, this means that he's at 1.8 million, the market starts to drop. When it hits 1.71 million, we commute and it rolls back to the retirement accumulation account. Now, what's happened is his original credit when he set the pension up was 1.6. Now he is rolling back 1.7. So this actually creates a debit in James's transfer balance account of 1.71. So that wipes out, obviously, the 1.6. It takes him right back to start, but in fact, it takes him into not a negative, but actually takes it back to a situation that his personal transfer balance account now is not 1.6 million like most people. It is now $1.71 million. Importantly, debits are not limited to 1.6 but carry the full weight of the rollback or commutation. Some of your clients, if the balance was $3 million and you rolled back, then a debit of $3 million sits in the ABP, enabling up to $3 million of accumulation. So he rolls it back. So in his TBA, he's got 1.71. After 6 months in GFC2, James got 1.6. So I haven't changed the circumstances, exactly as he was before, but he's got $1.2 million. Remember, that was in his ABP before. He's got his $400,000 sitting in cash. So now he's still got $1.6 million. I'm presuming there it's still in the same, exactly the same investments. But he's now got the $1.6 million in his retirement accumulation account. So it's a 400 plus 1.2. Now he believes the market's stabilised. So he can now, because obviously if the market is still crashing, he's still got equities, you don't want to start the pension until it's stabilised. So it's stabilised. So he goes in and he sets up a brand new pension. So that's the 1.6 million, which includes his core balance from the rollback amount plus the $400,000, which, remember, under the original strategy, there's no way in the world he could ever get that over to the pension side. So he puts that in. So not only is he's been tested for 1.6 mil, so the new pension that he's got over there effectively still leaves him with 110,000 further to be applied to a new pension. So he can actually continue to make contributions if he wanted to. Now, you've obviously got to watch out the tax and taxable componentry of the pensions versus the cash inside the fund and work through that. But essentially, to me, that seems to me to be a pretty smart way of looking at that GFC and putting that in place for your clients currently, simply by changing those ABPs. And you'll be able to do that once we get our new deed up and running. Recontribution to the spouse, let's face it, it's an oddie but a goodie. It's been around forever. We never did it before. We do the recontribution in order to uplift the tax-free component. But now we commute the pension or accumulation, and I'll go through quite a bit inside the strategies there, recontribute to the spouse. Effectively, this is strategies we used to put in place a while ago for reasonable benefit limits, which essentially the TBA is just another reasonable benefit limit. So we're trying to equalise amounts between the spouses, because if you've got a spouse, remember, it's not 1.6 TBA, it's actually 3.2. And you've got a whole family, well, gosh, you've got 6 lots of 1.2. So you're up around about a 7.2, which is quite phenomenal there. So in a really good position for that. The ATO's talked about recontributions before and basically said it's not part for A, but we need to, let me just jump up, but we need to make sure that it has been paid. So if we're doing that, we might say, well, hold on, we can't take the cash out. What we might want to use is, in this instance, promissory notes. Equalising balances between the spouses, but also we can, like if I had a look at the one before, John and Sally, we can also flip it down to Matthew, to Marie, and also down to the grandkids. So start to equalise between the lot. Can extend the generations, but you can also have an income equalisation account, and the Commissioner talked about that in his reserves ruling, so that we can equalise members' accounts through allocations from reserve accounts or by way of earnings. Again, that's getting quite sophisticated. Certainly something we looked at in detail and through the legislation on our 4-day course. The final one is investment strategies I've talked about, but you'll see with our new ILS Family SMSF Trust Deed that you can run separate investment strategies, but not only for all your superannuation accounts, but also for specific superannuation accounts. So you can have ones for pensions, you can have ones for separate pensions, or you can have ones for, say, the retirement accumulation account. So the key things there, the 5 ones, and again, have a look at the explanation that I've got in the strategist. Growth streams to the superannuation interest and is not spread. So you don't get that havoc there. So you can choose, for example, if I've got a tax-free account-based pension and a taxable component, remember, I want to try to get the tax-free because that enables a distribution on my death to my dependent beneficiaries is going to be tax-free. So the more if I've got a high tax-free component there, I want to get most growth in there. So I put my most growth assets in there, and at the same time, I will still have to take the minimum, but I'll take more than any minimum and my low growth assets out of my taxable pension. Then when I have my retirement accumulation account there, I'm looking for, because it's on the accumulation side, I'm looking for growth assets, not necessarily income assets. So we start to have a look around at what is best for us. As I said there, my second point, retirement accumulation accounts are for growth, not income. So really we're looking at growth, but we want to try and minimise our income. If we do get income, it has to be tax preferred or concessionally taxed income, such as franking credits, or in fact, ESIC is a perfect one for the retirement accumulation account, particularly when we've got younger generations coming in. If mum and dad don't need that money, then an ESIC is not a bad part of the portfolio because it gives tax shelter for the contributions being made by the younger generation. But if it really takes off, then effectively it's going to be passed on to the next generation. Different generations have different investment needs, so really pooled investment strategies don't work. That's probably one of the reasons why family SMSFs haven't really poked their head up. But gosh, if retail industry funds can actually work out different investment strategies by way of a wrap account, for those of you planners, what we're building inside the deed or the system is virtually like a wrap accounts for each and every member of the fund. So they've got their own little sub-fund inside their total SMSF trust deed. So again, it's a great new way of thinking about things. One of the dangers there is part of the gnarly bill also talked about LRBA liabilities that are apportioned across all members, and that if we have got a liability, it's actually going to be a credit to a TBA if you've got a pooled investment strategy. So as soon as you get an LRBA, you have to keep that as a separate investment strategy for the younger generation. And of course, we can fund taxation benefits and also payments, as I said earlier, that we may have. For example, John and Sally throwing up a lot of invitation credits that then flows back to the retirement accumulation, also accumulation accounts of the members, who can then make payments across there depending on what they see fit. So that essentially is our 1 hour up. Please make sure that you're on a session where I'll pull apart that case study and, more importantly, bring a whole lot of your clients' questions. If you've got any case studies that you want me to look at on Thursday, please send them to phil@ilovesmsf.com. So it's phil@ilovesmsf.com. And then essentially what we'll do is I'll pull apart those case studies. So that's where we start to get in a lot of depth. One of the things is you guys are already there. If you have a look at Branson, I love this one. If someone or somebody offers you an amazing opportunity, but you're not sure you can do it, say yes, then learn how to do it later. And that's where we are with family SMSFs. We're at that innovation stage. We want to put our hands up, learn as much as we can, and really start to build. And the next stage from our building, we need to do it. We learn the laws. We then apply the laws. The next stage for it is effectively to practice on our clients. Let's face it, that's what our clients are for. So we build a good strategic program, show our clients, upgrade. For those of you who are family SMSF advisors, again, get in touch with Phil, because I have got a day at your practice, and typically a day at your practice would be from 7:30 until 9 a.m. in the morning, where I come and do a family SMSF and SMSF strategies session with your distribution sources, such as accountants, real estate agents, mortgage brokers, planners around that area. We then go and then train your staff. Lunchtime, have a boardroom lunch with your top clients. And then in the evening, we sit down between 5:30 and 5:30 and 7:30, and we go and do a family SMSF session. And the purpose there is obviously to get your clients to upgrade and understand, talk about bloodlines, starting to understand this whole concept. And we'll go for dinner a little bit later on. So again, if you're already a family SMSF advisor, make sure you contact Phil. If you're not, and you want to upgrade from strategist or scholar, then look at doing so. As I said, I just jump straight in because, you know, I can see the end benefit that it'd pay off. I only just need two clients and I've covered myself, but it's also a way of following Branson, immersing myself in absolutely deeply. But anyway, there's a CPD point for this one. And as I said before, if you've a strategist, you can register another 2 people, they'll get CPD, and that's set at higher AQ life level. But look, thank you very much for your time. This will be recorded and it will be sent out to you, or the link will be sent out to you a little bit later on this afternoon, hopefully, depending on if I can get it up and running in time, along with the slides. And of course, you've got the strategist newsletter. And shortly in the future, it'll be also put up on your resources inside the website. So thank you very much for attending our first one, and looking forward to catching up with you very shortly. Anyway, it's Grant Abbott signing off.